Hello, my name is Dennis Louis. I am a Deputy Commissioner from the Inland Revenue Authority of Singapore and also the CEO of the Tax Academy of Singapore. As the Deputy Commissioner, I look after indirect taxes, law and investigation. And as the CEO of the Academy, we are a unique institution that partners other institutions in the world to bring tax education not just to Singapore, but to the world. I'm here in ITC Munich on the invitation of the organizers to speak on a panel on AI and rules as code. And I came to learn from the rest of the world, as well as to network with all the wonderful professionals here, including academics and many heads of tax and professionals as well. I think this is an excellent conference because in just over 2 days, I have made many new friends in the area of taxes, and I've learned many new things, especially hearing directly from the OECD, Dr. Akim, as well as all the other wonderful speakers. So I would commend this conference for you if you want to come next time, and I hope to see you soon. Thank you.
Hello, my name is Christian Kaeser. I'm the Global Head of Tax for Siemens AG. Actually, I'm based here in Munich. I'm as well the co-chair of BIAC's Tax Commission, and I chair the Tax Commission of the German Federation of Industries, BDI. And actually, my position as the co-chair of BIAC's Tax Commission is the reason why I'm attending this year's International Tax Conference, because the ITC in Munich, which this year is actually having its 10th edition, is a joint conference of BIAC, Business and Industry Advisory Committee to the OECD, of Business Europe, and of ICC, the International Chamber of Commerce. Those three international business organizations jointly organize this great conference, and I believe it's a wonderful gathering of top policymakers and top opinion leaders, both from in-house, from academia, from tax administrations, from international organizations such as the OECD. And this is making this conference very unique. The content is great. The setting is wonderful. I love my hometown Munich. And we're having wonderful side events, a nice evening. It's great for networking. And again, it's a great opportunity for exchanging on current topics. Actually, there is a question about the current economic state of the economy, especially if you look at the small and medium-sized enterprises in Germany and in many European countries. And it's a very diverse picture. For the small and medium-sized enterprises, I believe it's a tough situation to be in. And for some of the bigger MNEs, multinational enterprises, it's also a tough situation right now, because for Germany is heavily relying on its automotive sector, and the German car manufacturers, they're having a hard time. Chinese competition is intensive, and it's not only on price, quality is pretty good of those Chinese cars, and they are aggressively entering the European market. So leading in many areas around electrical vehicles. German car manufacturers are leading on the combustion engine, but that's actually not cool anymore. And the governments and European Union, they have been incentivizing big time the use of electrical cars. So this is not helpful for the German car manufacturers, and it's not helpful for French car manufacturers. And there are many smaller sized entities which are deliverers to the German car manufacturers. So the second tier companies, they're struggling too. And that's one topic. Then on the other hand, Germany has been relying for many years on defense security without paying for it from the US. All of a sudden with Trump, that's going to change. So we have to make up for this one. We have been relying on cheap gas from Russia. There's no cheap gas from Russia, and with the Iran war, actually, energy prices got another hike, especially the oil prices. I believe that is I wouldn't say a toxic cocktail, but it's an unpleasant cocktail, and this is why actually the German government is really focused on improving the overall environment. We'll see if they succeed. I hope that they succeed. And if you look to other European countries, it's a similar situation. Business mixes are different, but it's a similar situation. The challenges are pretty comparable. Okay.
These people around the globe, as we heard yesterday, one of the most important things for companies is to be compliant. I think this is one of the biggest issues.
Dear friends, we are now in Germany. International Tax Conference in Munich 2026 is just finished. And I would like to present you some of our guests. But before I present them, before they say a few words about themselves, I would like to tell a few words about the situation here, what I listen in these days. Unfortunately, it makes me more pessimistic than I was before I came here. So the future of our Western civilization, and I think my country is also from Western part of Western civilization, may be much harder than it is now if we don't find solutions for the problems it was mentioned here. So the problems or the situation given for now for the all European countries and not only should be rethink many times, and we need to find some way to go out from that. Otherwise, the crisis will come, and every country will see it. Okay, now let's go to our guests. Now today we have guests from America, USA, Mr. Daniel, and from Estonia, post-Soviet country like Georgia, Miss Helen. And I hope we will have interesting discussion about the problem we have here. First of all, let's give them word to represent themselves. I think Miss Helen will begin, would be more correct.
Thank you. Hello to the audience. My name is Helen Pahapill, and I work for the Estonian Ministry of Finance as a tax policy advisor. And I have been there for quite a while. I started in the year 2000, and I have mostly been active in the income tax field. This is where I began my career, and now I am responsible for the international and EU tax issues. That's it in a nutshell.
Yes, in a nutshell. Okay, thanks.
And my name is Daniel Bunn. I'm president and CEO of the Tax Foundation and also of Tax Foundation Europe. Tax Foundation is a US-based think tank that studies the economics of tax policy. We were founded in 1937. Tax Foundation Europe also studies the economics of tax policy. It is based in Brussels, and we were established just a few years ago as a sort of sister organization to Tax Foundation. We care about tax policy from the perspective of our principles. We care about tax policy that is simple, neutral, transparent, and stable over time. And as you were talking about the topics that we've heard at this conference, none of which is simple. Very little of it is neutral. It is certainly not transparent, and there is a lot of instability. So there's a lot of work for Tax Foundation and Tax Foundation.
I knew it was complicated, but it's much more complicated than I thought.
Yes.
Okay, so, and why is it important to make like these conferences? What for? Yeah. What do you think about?
For me, it's an opportunity to learn and connect. Certainly to learn a little bit about how policymakers and leaders in the policy community are thinking about current proposals and potential changes to tax laws. But it's also valuable to connect with other individuals who are, people from all sorts of different companies and industries, backgrounds, and learn what issues they are watching in the tax policy landscape, and see where there might be opportunities for our work to be impactful. We do a lot of research and education, and sometimes it's important to make sure your research is tethered to reality. And that's why some of these conferences can be helpful to make sure that we're not off in an ivory tower, meditating by ourselves, but are also among the people doing the work.
Okay, how about you?
I would say the same. I come here to learn and connect as well. It's always very useful to know what the business community and academia are thinking of the current issues. I mean, we are in contact with our local business, but here it's a more, you have more international coverage, and that's very relevant because then you get to see things from very different perspectives that you otherwise might not have if you only relate to your own colleagues, even if they are from the different member states.
Yes, and so differences between different countries sometimes makes problems. Therefore, freedom from Europe is given, and we know about this. But because of differences in laws and attitudes from the government, it may be some problems between countries. But how about inside countries? So how the situation of freedom of business or freedom of economics in your country and your country?
So maybe it'd be helpful to frame the way that I think about this issue. So Tax Foundation every year publishes something called the International Tax Competitiveness Index. It is not a study of how much a country taxes, but how they tax. The design, the policy designs.
More important than how much.
It is often more important because two countries might raise the same amount of revenue, but one might have an incredibly distortionary system and is holding back opportunities for growth and investment. So just looking at the amount of revenue doesn't give you the full picture. So for the US, we were ranked 15th in the index in 2025. There are a lot of policy changes in recent years that have improved our ranking. We were very low in the ranking about 10 years ago. And the US has been very focused on reforms that move to a little bit more certainty and a little more pro-growth and in some cases lower taxes. But the index also shows countries like France and Italy that have incredibly complex systems that hurt both individuals and businesses on their way to success. And then you have countries like Germany where we are currently. It's ranked 20th on our index, which is relatively middle of the pack for the OECD countries. All 38 are part of our index. And one of the challenges that I see, particularly for Germany, and Helen can talk about what it looks like for Estonia, is the dynamic between what German policymakers might want to do on their own and reforms they might want to do on their own versus the dynamics with the fact that Germany is one of 27 member states in this union, and the Commission, the European Commission itself, has tax proposals that impact German policy landscape, and particularly the new global minimum tax. It's not guaranteed that what we see today with this policy will be the same policy that we see 4 or 5 years from now, but it is something that is put onto member states along with their own approval that changes the dynamic for taxes.
Yes, so you mentioned so many different countries.
I'm sorry.
I'm a bit confused.
Yeah.
So, okay, so Miss Helen.
Yeah.
When we are talking about the Tax Foundations Index, then it's easy for us. We have
Estonia should be in higher place.
Yes, we are at the first place for many, many years already, and we are really proud of it. Also, when you look at the some other indexes that talk about the economic freedom and then specify their criteria, then we are rather on top of it. It's easy.
Yes, I always say that Estonia is almost in first 5 all time.
Yes,
usually.
Somewhere around there, which means it's easy to do business. There's not too much regulation. You don't often need licenses except for, some specific areas like banking and insurance and sale of alcohol. So in this sense, I think on the one hand, we can be relatively proud of ourselves, but we also need to work hard not to lose this ranking. Because like Daniel mentioned, it's not only to be determined by our domestic policy, but also the EU policy. And tax policy in this regard could be said to be perhaps one of the, I don't want to say easiest fields, but all the tax acts that are adopted in the EU are done so by the unanimity, which means that every member state has to agree. So if something is really difficult for us to accept, we can say no and then negotiate until we can find a compromise. But most of the other areas in the European Union, their legal acts are adopted by qualified majority. And since Estonia is such a small member state, our voice does not count nearly as much as that of the other member states that have a much bigger population. Which means that in certain areas like agriculture, even customs, financial services, accounting, etc., we often have to implement and apply the rules that have been decided even if we were against it.
But some countries, and your country too, can not to attend to some rules from Euro Union. As I remember, maybe sometimes it can be some fines for it, but anyway you can not implement the rules you don't like.
I wish it was that easy.
I understand that it's not easy.
There are some, I'd say a handful of the EU directives that we have not implemented and where we are paying a fine, but it's an exception. So in the end, the question would be, why did you join the European Union if you don't want to be part of the single market? But it sometimes is difficult, and it's also difficult to explain at home, for example, to the farmers, like, why did you agree to this rule that might not make perfect sense in Estonia? And you may explain that it was a compromise between the 27 member states. Yeah. But if it doesn't work for us, again, it's difficult to explain. And then people often tend to point to Brussels, that the rules come from Brussels. But I feel that we as the public officials, we cannot really do that. We need to take the responsibility because we do participate in the negotiations as well as we can. But sometimes we just need to accept that we do not get the result that is best for Estonia, but we might get a result that is hopefully best for the EU as a whole.
But if Estonian government understands that some rules is not suitable for Estonian situation, it's quite a big plus, I think, because some governments implement their rules from European unions, totally don't understand what it will take for their own countries.
And often these rules just don't work in practice. Like I mentioned also in my presentation, that in one of the tax directives, or the tax avoidance directive, we have agreed to it. But these rules have much less significance for us than they may have for the member states who were really wholeheartedly supporting the directive at the time. But on the other hand, I mean, these rules are in our legislation. They are not just implemented very often. So you could say that there's extra regulation, but there's not much use for it, but maybe it also doesn't harm anyone. But we always need to weigh this option.
So the government always tries to soften the situation.
With the tax rules, we have the option of transposing them into the national law, which means that you have to make them fit into your existing system while preserving the objective of the directive. And the European Commission very carefully checks how we have succeeded, whether something is missing, and then there's a specific procedure to notify us, and then we negotiate with the Commission what to do. And then if the member state doesn't agree, the Commission could take us to the court.
Okay, quite complicated situation anyway. And when I think about Estonia, it's should be much simpler situation than for example in USA, because in USA they have tax codes maybe 1,000 tons or so. How much I don't know, I don't remember.
It's more than the entire set of the Harry Potter series. It's longer than the Bible. It's billions of compliance costs every year. In fact, it's one of the relatively more complex tax systems, and it's not only complex because it's because of the rules that are made in Washington D.C., but we have 50 states. We're a federal system, so there are state and local rules as well. And these rules do not always match. So if you are filing your income tax, there might be a federal definition of what income is that is different from the state's definition of income.
What happens if they conflicted?
You might get taxed twice.
So we have the situation in European Union that we think how to make the laws not to tax twice, and you have in your country double taxation.
Especially for businesses that work in multiple states. Our courts, so in theory, the US is a frictionless internal market. Mm-hmm. And I would say for many cases that is the truth. But when it comes to tax, the courts have decided that as long as, let's say, New York's rules, if all states had New York's rules, there would be no double taxation, then New York is free to choose those rules. And that's the way that this has kind of been decided. But it's not the case that each state is then free to set rules that from the perspective of the court would be fine from a double taxation standpoint for all other states. And there are various ways that states, that companies can mitigate some of this, but it's a complicated system for sure.
So New York is another problem, one big problem.
I would say our International Tax Competitiveness Index does not account for quite as much of the complexity at the state level as it could. But we do include some of the state level calculations for some of the indicators. We have a separate study that's just focused on all 50 states. Yeah.
So I understand 50 states like 50 different countries. So they are.
And some of them are very much like countries themselves. I mean, the state of California has an economy larger than
most the people live California.
Yeah,
I have read that 2.5 million people live
going to Texas
in the last few years, because of taxes.
Yeah.
So it's very important, but I don't know how the bureaucracy and politicians think about this.
Some of them think clearly about it, and they recognize the risks of having tax policies that drive businesses and individuals away, and they want to work to mitigate that. They recognize that they have to raise revenue that supports their spending programs, or there might be a need to cut spending in order to achieve reforms that might be more competitive. But a lot of politicians are simply fine to say, well, so be it. You're allowed to leave if you want to.
Only resist only till the next election. Okay, how about in Estonia? As I know, Estonia, I don't think it's inside problem, but immigration problem should be in Estonia, is not it? Immigration from Estonia.
I don't think it's much of an issue. It hasn't been in the news lately. I guess that Estonia is doing well enough that the people don't need to leave. As to the businesses, what we have heard from the tax advisors and also the lawyers who advise on the mergers and acquisitions or business reorganizations, then in the recent years, some businesses have left, but that's mostly for the geopolitical reasons. It's not really a public information. You could say that these are rumors. Very few make it clear why they leave. We do hope it's not for taxes, although we have raised the taxes in the recent years. But also we hear of other businesses who are interested in investing to Estonia. So I don't know whether we will break even or not.
It's interesting. But a very important thing, why we speak about immigration or about leaving the state California, because the reason of this happening is taxation system. So we are speaking about taxation these days. Now the question is what we understand for that situation, for the meetings here and from the words it was said about in different segments of taxation and the different attitudes of taxation. How can we unify the situation for different countries?
Well, I'm a fan of tax competition. I think it's good for countries to be able to experiment with different tax policies. That doesn't mean that all the experimentation is actually good, but there's a lot that can be learned from different situations where perhaps whether it's on the policy side or the tax administration side, that some countries might want to do something differently. And this is one of the things that I talk about a lot of times. In all sorts of parts of the economy, competition is good. It increases pressure for good business practices and increased pressure for quality of services or products. And similarly, competition can support the way that governments think about providing goods and services for their citizens, whether that's something as basic and important as defense, or something a little more complex with some of the welfare states that we see.
But point here was to unify the situation between different countries.
Yeah, I think the unification efforts often lose on the opportunities to learn from new and different things. I think a lot of policymakers that are interested in harmonization ignore the fact that there is not one system that will fit all situations. And in fact, when you start to force that, you recognize even more how different the individual systems are.
Yes, as Helen also said, that Estonia does not want some rules to take from European Union. So it's understandable for me, but European bureaucrats maybe don't want to understand this.
There are some administrative things that I think are really important. Some things where it's more obvious that alignment on tax policy makes sense. So I think, for the EU as a customs union, a lot of the EU rules connected to consumption taxes, value-added taxes, are important because you want to be able to make sure that the internal market is working appropriately, that different interpretations and standards within different EU member states could create frictions for the internal market.
And also different level of VAT in different countries, as I remember. Also, not only from different countries, but in the country, different goods has different.
So not necessarily on the rates, although there have been some. There are EU rules connected to kind of how many different rates or discounted rates you're able to provide, and the Commission often, I would say, lectures member states on how to broaden their value-added taxes, but particularly on the administrative side, how you might be able to reclaim VAT or what your filing might look like, and simplify that. Now, that similar logic is often used by the Commission to do things on direct tax, on corporate income tax policy. And it is less clear to me whether they are interested in simplifying things for administrative purposes, or if they have in their mind the perfect, in their mind, EU harmonized tax policy that they are really leaning towards. And it is that's the challenge that is common.
So I don't like the word perfect in their mind, because socialists have perfect society after some while.
Yeah.
So I would like now to ask to Helen. So as I know, you have 25% VAT tax in Estonia.
24 at the moment.
But in different countries, we have 22, 19, somewhere 18. And how it works when the goods move from Estonia to another country. So you don't tax, but you have not custom service. And how can it be registered or understood by revenue service system administration?
I'm not familiar with all the technicalities of it, but there is a system for that, that if your sales exceed a certain amount, then the VAT has to be paid in the country where you sell the goods. Yes. So there is a system for that in the EU VAT system.
It's understandable. It's clear. They register all turnover, and they look to turnover after, for example, 100,000 or how much is it, the level. It's clear. You are a VAT payer.
Yes,
so,
but then it also
if you move your goods from one country to another country and you have not custom formalities, how can they understand?
They have to understand in a sense that if you already are a VAT payer or the VAT liable, then you need to know the rules. There's this general principle in law that you're not excused if you don't know the rules. And it's based on the self-assessment as a first step, which means that if you already sell goods to the other country, then you have to know that if you exceed a certain threshold, which is not the same as your local VAT threshold, but just on the sales, then the VAT has to be declared and paid in this country where you are selling them.
So the companies are declaring themselves to Revenue Service Department, maybe, and like this. So it's clear.
And we have tried to simplify these rules in the EU as well in the recent years, and this work is ongoing.
The situation with US is much more complicated because they have not VAT tax at all.
We have sales taxes.
Yes.
They are not VAT. There is not a reverse charge mechanism or a credit invoice system.
1 minute. So whenever I think about this, I prefer sales tax, not VAT, because VAT is something another. Then sales tax is much simpler and much easier to understand. You don't depend on others' payment on others. So you decide yourself.
So the problem with sales tax, especially in most US states, is that there is not a clear exemption, or rules have to be written to provide exemptions for business inputs. So if you don't exempt business inputs, and this is a natural thing occurring in value-added tax, if you don't exempt business inputs, then what you get is tax pyramiding for the sales tax. So the business pays sales tax when it buys its input, and then the next level pays sales tax when it buys its inputs, and again, and you get a pyramiding effect.
So with, for example, if it is if you have sales tax 5%, then if you sell it 4 times, one to second to third, and so on, it's 20% already.
It can
not 20, more than 20%, because
it can be,
5 plus 5 is not a 10; it's more than 10.
Exactly.
Now it's time to go to finish, but I'd like to zoom the situation from our conference and from our conversation here. What do you think about the day tomorrow? What should we do to make better tomorrow and to diminish my pessimism?
Mhm. So one of the things, and this is a challenge for me that I see happening a lot in tax policy, is the high level of attention and conversation and policy debate around corporate income taxes. Corporate income taxes are the most harmful for economic growth, especially poorly designed corporate income taxes, because they punish capital investment, which is a key factor for long-term economic growth.
Yes, Estonian model is much better in this case.
This is absolutely true. They also punish innovation, which is another key factor for long-run growth and prosperity. And yet we spent and often spend days and weeks, in fact, much of our lives talking about corporate income tax and the ways that it gets worse and more complicated. And in fact, the global minimum tax itself is essentially an agreement by many countries that, well, we need a permanent level, at least a minimum for corporate income taxes.
How much is it?
15%. But it's an incredibly complex calculation. And it's something that has completely changed the thinking at the policy level about where tax policy fits in. So to make you a little more optimistic, I think where we are in the conversation this week is, and continues to be the case, people realizing how difficult it is to accomplish this idea of, again, the perfect, in theory, harmonized corporate income tax. So to the extent that people get more and more exhausted with this project, it provides opportunities for conversations about what the tax system could look like and the value for looking at changes to maybe personal income tax or value-added tax. If there's a need for revenue, there's opportunities to raise that revenue in ways that are less harmful to long-term growth, and recognize, which is the case, that corporate income tax is a relatively small share of revenue. For most OECD countries, it's about 10, 12%, and
Yes.
focus more on these other taxes.
So they are supposed to make them 15%, as I understand. So how much is the corporate tax in Estonia?
At the moment, it is 22%.
20, too much. But you don't pay it.
Whenever somebody says that, but you don't pay it, then we say, but look at our revenues.
Yeah.
And if nobody paid, we couldn't really collect anything. But
so here is one question: how many percent does it make in revenue service? Because, for example, usually most revenue comes from VAT, not corporate
True.
tax.
Yeah. It's the same is true for Estonia. But like Daniel said, corporate income tax it's a fascinating subject. We have intellectually very stimulating discussions. You have very good and smart people working on this field who may be earning a lot. But in the end, it doesn't bring in much revenue. So there's this paradox that we spend a lot of time on it, but in terms of revenue, it gives quite a modest result.
I did not understand. Do you understand?
Yeah, I mean, so it's kind of, as she said, a paradox. There's a lot of talent, a lot of time spent on corporate income tax. It's a very complicated part of tax law, but at the end of the day, it's a relatively small share of total tax revenue, and it's a little frustrating. We talk about in taxes in economic terms. We talk about deadweight loss.
Here is the problem. If you should spend more amount to pay salaries for these excellent experts,
Yeah.
Why should you do that? Make it zero, and you don't need to spend anything.
Whenever this topic is raised, then the justification for the corporate income tax seems to be that it's politically impossible not to make the legal persons pay, because individuals do pay tax. So the individuals could get upset that businesses don't pay, although in the end there's always an individual behind the business. But having a company may give you an opportunity to either to delay the payment or taxes, or to reduce your tax liability. But there's a reason why the legal personality as such exists. It is in order to provide some sort of shelter, I would say, or to limit the person's liability, because otherwise people would be very careful and afraid of taking risks. So it's a vehicle for the entrepreneurial people to do something, you know.
I think it's not quite correct, because corporate income tax means that you should tax corporations which works on something, makes new projects and so on. So if you take the money, if you tax them, they will make less projects, and the economic growth will lessen. And by other hand, if you look carefully, and the corporate tax is taken from the corporation by individuals, by owners, they should pay income tax, and that's all. And if you have same income tax,
but there is one, I think, one very pragmatic saying is that companies don't vote, which means that, again, if the people have the perception that, you know, the companies should also pay, although you can say that, have you ever seen a company as such? You haven't, it's a fiction. And if you have a lot of people who are your voters when you're a politician, and
yes,
they demand
this is political problem.
This is the political aspect of it.
Yes, I understand. It's a very big problem, and maybe biggest problem to make any reforms. I had this when I worked with some few people to explain them something that's better to do in like this way. It's much complicated for them to leave as it is and to change something else. But okay, let's finish about it. So let's now zoom our conversation. You can say anything you would like to finish your.
I was thinking about your previous question regarding how can we give you back hope. Like what should happen? And I wish that all the countries would have enough wisdom to make a difference between the tax questions that should be dealt with, you know, individually by the countries, and then the aspects that need international coordination and cooperation. I think this lately, this wish to harmonize and not even coordinate, but to harmonize the tax rules has gone a bit too far. Because as was also said quite many times at the conference, one solution usually does not fit all. So
yes, certainly.
We would just need to establish this appropriate level of cooperation, then agree on something, and then also follow our agreements, because otherwise it's worthless. We also heard that the taxpayers, you know, yearn for certainty. We as the governments as well. So if we could be so wise, I think that could be a source of hope for everyone, that life will get better.
We need to be wise somehow. We should reach. And
I would agree with that. You know, in this world, you need coordination at some level, right? You need dialogue across borders. to solve.
Yes, I don't think
collective issues.
anyone thinks in a
But the
different
question
way.
is at what point are you having coordination that facilitates trade, or are you having conversations on policies that end up creating barriers to cross-border trade and investment?
Exactly.
And what we have done over the last 10 years in corporate income tax policy is the coordination became, well, we're going to harmonize, and the harmonization created new barriers and frictions to cross-border investment in particular. So to Helen's point, I think there's an opportunity to reflect on the current state of things and maybe take a step back to the coordination rather than the collective setting up of new barriers.
We need golden ratio. Looks like this.
Yeah.
So. But we need to be too wise to find this golden ratio. Okay, I think that's was quite interesting conversation.
Thank you.
So thank you for the participation, and I hope we will meet one more times or more times. Yes.
Thank you so much.